Betting on short-term interest rates. Interest rates are a market like any other. Quite simply, you are either buying or selling a quote. So if you want to trade on the movements of UK interest rates, perhaps to hedge your mortgage payments for instance, you can bet on the short sterling future. Their price is directly determined by interest rates. It's calculated by subtracting the implied 3 or 6 month interest rate for the relevant country or region from 100. For instance, trades on British interest rates are on the short sterling contract and those on US rates are on the short euro-dollar contract. If you've never traded short sterling before, the way it's quoted can seem a little awkward at first. Just remember that the trade works just the same as they have before. You can go long or short. Your profit is the difference between your opening and closing prices. The key difference you have to realise and take note of regarding interest rates is what the price quoted to you actually means. The price of a 3-month interest rate contract is quoted as 100 minus the interest rate. For example, if the March interest rate is 8%, then the contract price will be 100 minus 8, which is 92. It'll be quoted as 9200. If the March rate rises to 8.3%, then the contract price will fall to 100 minus 8.3, which is 91.7. It'll be quoted as 9170. So if the rate rises, then the spread bet value falls. If the rate falls, then the spread bet value rises. So if you expect the rate to rise in the future, you sell the future contract because the spread bet will fall if you're right. If you expect the rate to fall in the future, then you buy the future contract because the value of the spread bet will rise. Short-term interest rates. Short sterling. The most popular bet on short-term interest rates is the 3-month sterling deposits contract traded on Life, better known as short sterling. Short sterling is a 3-month interest rate future which is highly correlated to base rates. If base rates were unexpectedly raised by 1%, then the short sterling contract would also rise by 1%, or as is more commonly known, 100 basis points. For example, June short sterling has a price of 95.63. The market is predicting interest rates in March to be 4.37%, or 100 minus 95.63. Therefore, if you believe that short-term interest rates will fall, you would buy the contract. Conversely, if you believe short-term interest rates will rise, you would sell the contract. Example of an interest rate trade. There have been bullish comments from the Bank of England. You believe it may be about to raise interest rates. The spread betting company is quoting the short sterling June contract. You choose to sell £30 per point at 9,444. Your prediction proved correct and interest rates increased from 5.5% to 5.75%. You decide to realise the profit you have made. You buy £30 per point at 9,425 to close your position. Here's how the profit is calculated. Your profit is £570. It is important to remember that the value of the short sterling contract doesn't just change when the Bank of England changes its rates. The price of the contract is always changing. It reflects the market's view of what is going to happen to interest rates at some time in the future. As news and economic numbers are released, the market will change its mind on what the interest rates will be. At the time of writing, base rates stand at 4.5%. The January 3-month short sterling contract is trading at 95.41, implying an interest rate of 4.59%. The market believes there is a small chance interest rates will rise in the next 3 months. The currency markets provide another way of betting on the movements in interest rates. When interest rates rise in a particular currency, that currency tends to rise too. The currency becomes more attractive to investors because they can achieve a better income for their cash. The buying of the currency associated with an interest rate rises pushes the price up. However, there are exceptions to this. For example, when sterling was pushed out of the European exchange rate mechanism, so it's important to be careful.